So you're super excited that you're ready to finally buy your first rental property, and you've been doing tons of research on what to do when you have that rental property. But you want to make sure you don't overpay. So today we're going to go over tips and methods to buy property under market value. Okay, I'm going to talk about 3 different ways that we're currently buying property below market value, and I'm going to leave one more at the end where we're working on a deal right now. So the first one will be foreclosure auctions. And we talk about this a lot on our channel, so I'm going to only go over it briefly. Typically, you have a mortgage company that is foreclosing on their loan to this house, and they hold an auction to basically reclaim their deed or sell it to a third party. You can often attend these auctions either at the courthouse or at the steps of the property, and you'll want to find out if it's a judicial state and maybe they have a listing on their state website, or if it's a non-judicial, and find the third-party auctioneer that's hosting the auction. Often you can find this also in your Sunday newspaper to get more details. Now, one of the big mistakes that they make are that they do not do a good due diligence in finding out whether there's back owed taxes, there's other municipal liens, IRS liens, stuff like that. You want to really take the time and do the due diligence prior to the auction to have this information. Also, if it has a septic system, when was it last pumped? When was it last serviced? Is it maybe failed? These are information that you're going to want to know because you're buying an as-is property. So that means you're basically, it is what it is, you get it. So once you attend the auction, you should have all this information, and then you work up your maximum allowable bid. This is the number that you will not go above. This is the number that you should stick to. And this is another mistake that I constantly see is people get all in the hype about bidding at these auctions, and someone else is bidding, and so that gets them excited. Oh, well, they must know something I don't know, and they start bidding more, and then they're overpaying for the property. This just happened last week where someone overpaid and did not realize that there was $15,000 in back taxes owed. So they're probably going to try to get out of the auction and maybe lose the $5,000 deposit. I don't know. I wish them all the best, but that's one of the big mistakes that they got all excited and also didn't do their due diligence. So we've found and had hundreds of properties that we've acquired through foreclosure auction, had some great deals, had some bad ones, but we've learned all these lessons, and this is one of the things we're actually working on a book right now to talk all about that, to help educate everyone about what we have learned and the kind of trials and tribulations that we've gone through. Foreclosure auction can be great. Typically, there is a general bidding strategy we like to talk about is just kind of, having our number and trying to keep within a certain range so we're not going too high, but also maybe scaring off other bidders. So we kind of play that. There's a lot of different books on, negotiation / mind tricks you can play out there. I really, don't play a lot with that, but that's something you can look into for other books. That's not really something we talk about a lot here. The second is pocket listings. This is where you work with a real estate agent and they're giving you first shot at a deal that they just put under contract to get listed, and they're going to give you a shot to look at it, maybe put a bid in before they open it up to the MLS or the whole market. And that's where it generally gets driven up, especially these days. So you do need to do a few different things. You're going to want to be very decisive because these people that you're working with, they're going to want to know that you're going to act quickly. Ideally, they're going to pay in cash, but not always, but often you'll pay cash. That helps the transaction move much quicker. They're going to want to know that you're someone that won't renege and go back on your word. So if you say you're going to buy it at X, you're going to buy it at X. They want to know that you'll actually close. And when you show them consistently that you're closing deals, they're gonna be sending you more and more deals because they're gonna know that they have a buyer they can always go to and get this deal locked up. And this way they're not having to deal with a bunch of different buyers that maybe pull out at the last minute, and they've spent tons of marketing dollars and time working on a deal where they can just go to you and say, all right, Matt, here, will you buy this for $1 million? Great, and you of course do your due diligence and stuff, but then they'll know that you'll close. Now you're still gonna want to do, like I said, all your due diligence, run your numbers, make sure you look at what your return on investment for rental property is really, really key, that you're buying right and making sure that you're getting a good ROI. As always, use something like the 70% rule is a good kind of rule of thumb. Look at actual cash flow, not the pro forma data that they'll often put together, because that's projected potential. You want to focus on what the value is today. So you want to make sure ideally, we're all cash flow investors. We want to make sure we're cash flowing from day one, or at least break even, and know that there's a real upside for you to get that cash back, or potentially do a BRRRR strategy so that you can actually get your cash that you're locking up, quickly back. So you figure out your different methods. We talk about BRRRR here. We have different videos on that. We talk about also doing cash flow buying and how to actually evaluate a property. But basically, the gist of it is look at the income, the actual income, minus expenses, and then look at what you're putting in as your capital investment and see what that returns. So for instance, you're putting $100,000 on the property, that's repairs and acquisition, and then you're getting at the end of the year, you're netting after income and expenses $10,000, so that's a 10% return. So is that what you're looking for? Is that something acceptable to you? Everyone's metrics are different. I was talking to a friend of mine yesterday, I think, where I was saying I want at least a 15% return. He's like, well, I really prefer more 17, 18. Like, all right, well, I'm not going to complain about 17 and 18, but at least if I get 15, I'm a happy investor. And kind of, for me, slow and steady makes the race. The third way is owner financing. This is where we're going out and finding deals such as with PropStream that have no mortgages on it, and where we're going to talk to and negotiate with the owner and figuring out what is their exit strategy as well as ours, and find terms that will work. So this way we can play with the interest rate. So maybe we can get them to go below, what the actual banks are offering. Maybe we can, give them a nice balloon in 5 years because they want to be out after that. But maybe they give us an amortization of 30. So therefore we're keeping our cash flow, and maybe there's a value add. So that gives us that time to do the value add, so that therefore it's actually still below market value and then when we refinance with another bank to pay them off, and then they're also happy because maybe they're getting interest, so they're getting their the value they wanted plus the interest, so they're getting a nice little cash flow while we do the work. This is a very great way that we can negotiate and figure out what works for the seller and for the buyer, and figure out a good medium that works for both parties. So we've done this on a few. We've actually done some deals where we actually were able to get the owner to finance at 0%. So they basically let us take control of the property. They got no payments for 6 months, but that gave us the time where we were able to get the deal done and get all the value adds and go to a bank and say, great, we own this property, this is all the value adds, and we were able to refinance with the bank, pay off the owner because we gave them the terms and basically the price they wanted, and they were fine. They didn't need any money at that time. They owed nothing on the property. We then took over the property. And their recourse was, of course, if we didn't do what we said we're going to do, they then acquired the property. And what we also did is if we did not refinance in that 6 months, then they would owner finance it at 8%, basically at a high rate, for another 2 years. So this way, even if we didn't get the deal done and all the work done and all the value adds done in that time, we were then able to work out some things that we still had a little bit more time, but then therefore it was a higher incentive for us to get the deal going much faster. There's a lot of different ways you can structure it, but you want to it's all about putting it in the spreadsheet, looking at the math, and figuring out what works for the seller and what works for you, and finding that price and terms that work for both parties. So the last thing I told you, I was going to give you a fourth strategy, and this is something that we haven't done yet, but we are working on it. And I think that there's going to be a lot of opportunity in the coming months as basically interest rates are going up, yet people maybe they can't run the property right, and maybe they had a note or a mortgage from months prior or years prior, but they just can't make it work. And so you could step in potentially and do an assumable mortgage. So where you can take over their mortgage payments, and if they've got a great rate, yet it's something that you can't get right now, and do something where you're assuming that mortgage, maybe you assume it for the whole life of the mortgage, or maybe you assume it for a short period of time, and you also maybe give them a top deposit. There's all different ways you can structure it. But that assumable, which we're working on a deal right now where we're going to assume $1 million note, and then maybe even restructure it with the bank, and to actually make it a larger note. And there's a lot of different ways you can play with it. We're still figuring it out, but I think there's going to be massive opportunity for deals out there where owners just can't make the rental property. Maybe they're just not cut out to be landlords. They don't have a good property manager in place, whatever it might be. But you can step in, you see the value that there is, and the fact that they have a low rate that you can lock in. Maybe it's a 30-year fixed lock rate, maybe it's a 20, whatever it might be, but you see that there's a low rate that you can get at. Maybe there's got something in the 3s or the 4s, and right now all you can get is something in the 6s or the 7s. So obviously now you can do the cash flow analysis on that, the ROI, and see that, wow, if I assume this and maybe give them $50,000, I can make a deal work. And maybe that's how it is. Maybe it structures that's the whole thing where you just assume that mortgage and just pay that off, and they got their money and they're happy to walk away. Now, if you keep it in their name, there's a lot of things, nuances you're going to want to talk to your lawyer about for assuming the mortgages and making sure that you're doing it the right way. So look into that. You're going to need to look at the note and make sure it is assumable. As always, guys, I'm the Flip and Learn Ninja, and I'm half of Two Guys Take on Real Estate. If you like this video, make sure you subscribe, and we've got your back on real estate tips, tricks, and hacks. And if you like this video, check this one out here.